What tax do you pay if you flip a property? Brilliant question, and it is answered in this video.
Okay.
So basically, the question is around flipping properties. And they say, what are the ways to flip properties inside of a limited company? Are you able to live in the property and save CGT that you're flipping? Let's just put this into context. So you have a building which you want to buy, and then you're going to refurbish it and then sell it without renting it. Okay, so that's the context. So immediately, the thing I would say about this is anyone flipping properties, you need to be mindful of, if it's in your own name, it is income tax, not capital gains tax. And therefore, you don't get the £12,300 worth of capital gains tax annual exemptions. You don't get the 18% tax rate for residential property as basic rate taxpayer, or the 28% as a high rate taxpayer. And in fact, what you get as a basic rate taxpayer is an income tax charge of 20%, plus 40% if you're a high rate taxpayer, and national insurance to boot on top of that. So from a tax perspective, I would always say if you're looking to flip a property, do think about using a limited company. We've just been saying all this way.
Yes.
There are other ways of other limited companies, but it does...
When it's a flip, often it's more tax advantageous, as well as, if I put tax aside, sometimes it's that security of knowing that if something were to go wrong, and we all hope it won't, and you were to be sued, actually that suing or litigation activity is corralled inside that limited co, and it's not putting anything else in your personal name at risk.
Yeah, and I think just to echo on that, here's a question to you, but would you put an asset, you've got a limited company already, you've got some buy-to-let properties, would you then say, well, actually, I've got this limited company with all these properties, I'm going to throw a flip in there as well?
Well, I think, without sounding too much like a politician, the answer is almost another question, which is, how would you feel about losing all of that portfolio if something were to go wrong with the flip and you were sued and the damages required you to sell everything to cover them?
And that could happen, couldn't it? And you have to watch about tax structures, because I have seen people, create a limited company, then they've done a subsidiary. A subsidiary is a company owned by another company, or they've done a holding company, but it's in totally the wrong structure because of things like inheritance tax planning, extracting money out of a company. You've got joint venture partners. They haven't got the right share structures, etc. We can go all day in terms of why people set up limited companies in the wrong way. And we see, to be honest, I would say 8 out of 10 clients that come to us, we are rejigging their share structure. That's the first job.
Sometimes a little bit, sometimes a great deal. But there's always some
You're being
efficiency
nice.
to be had.
You're being nice.
There's always some efficiency
The tax
to be had.
advisors, we do an awful lot. And that's simply because, and that's not saying what they did was wrong. It was just that fact that we've been in this game far too long to know the traits of what you can do better. So I always say to people when they come on board is, have I done this wrong? And I say, it was right at that time. What I would say to you is that let's make it better tomorrow. And don't kick yourself a history of yesterday. And I always say that to people, and I always say it to you guys as well. But, so in terms of flipping, I think do it in a limited company. You do have to bear in mind about TAR. There's another 4-letter word for you. So
Targeted anti-avoidance rules. They're also lovely. And I'll come on to those in a second, if I may, because there's a comment down here that Anissa has put, which is about, could I save capital gains tax by moving into it? So let's imagine you have bought it in a limited company. Any tax that you're going to pay on it, whether it be income tax or capital gains tax in the company, is actually going to be at the corporation tax rate. So there is no, unlike in your personal name, there is no variance under a corporation tax header, unless you happen to do something like either move yourself into it or somebody within your directorship groups. And then you end up triggering lots of additional taxes, such as ATED. So I'm not going to talk a lot about any of these additional tax points, but I just want you to be aware of them and go and discuss them with your tax advisor or accountant. ATED can be very easily triggered and is an extra minimum of £3,500 tax a year. And woe betide you not pay it or not file the right return at the right time if you are going to be caught by this tax. Not all properties in a limited co are caught by this, but some are, and you need to understand the conditions before you make any decisions to move into such an asset. So for me, perhaps looking to move into it is actually going to almost shoot yourself in the foot, because you're going to trigger more tax rather than save tax. Even if ATED doesn't apply on such a property, if you moved into it, you could be picking up personal tax because it's now classified as a benefit in kind. A bit like having a company car, if you're familiar with that. It adds tax to your hand, and so could living in a property that your company owns. So be careful.
That's a very good point. Very good point. And again, that's a very big difference between anyone thinking about using personal name to buy and rent out properties and then eventually sell it, because you get your capital gains tax annual exemptions, as well as potentially private residency relief,
Yes.
which you do not get inside of a limited company.
No, you don't.